I'm Matt Bishar with NAREITWeek.com. I'm here at the Waldorf Astoria Hotel in New York City for REITWeek 2016, NAREIT's Investor Forum. Joining me today is Phil Owens, Senior Vice President of Advisory and Consulting with Green Street Advisors. Phil, thanks so much for joining us.
Thanks for having me.
So not long ago, there was a handful of externally advised REITs that were formed with what appeared to be modified business models. What made these companies different from the externally advised REITs that we saw in the past?
It's a good question. And so in the past, we saw externally advised REITs that didn't have alignment of interest between management and shareholders. So there were fee streams for all sorts of things like acquisitions, dispositions, capital raising, asset management, but there was very little alignment between total share price performance and external advisor compensation. Today, some of the newer arrangements have situations where there's one fee. It can be based upon asset value, it can be based upon market cap, and there's an alignment of interest between the external advisor and the REIT shareholders via a participation in the overall performance of the company. The challenging addition to some of these new companies has been long-term management contracts that really affect the value of the company. And if they're canceled sometime between the time they're put in place and the time that they end, all of the payments are accelerated. So unfortunately, we're not sure if the external REITs of the past are better or worse than some of these newer breeds we see today.
So how have these companies performed?
Looking at performance, you have to look at a couple different things. There's share price performance and total returns, and that story is somewhat mixed. We see some that do okay and some do poorly. The real story here is in their cost of capital. So REIT shareholders, they vote with their dollars, right? And so what they've consistently voted is they voted down on external advisor. So what happens in these companies is they might show a share price performance that's consistent with a peer set, but they trade at massive discounts in terms of their overall value relative to their internally managed peers. That cost of capital challenge makes it very difficult for these companies to grow in a way that's value accretive.
Now, is there any changes to the structure that could address some of these issues?
There are, and I think it's important to note it's going to be very difficult for an externally advised company to have the same kind of alignment as an internally advised company. That said, things like reducing the overall size of the set fee and replacing that with something that's more total returns based so that the management team of the external advisor really truly is aligned with the shareholder would be a good start. I think second, having these long-term management agreements where people put a 10, 15, 20-year contract on the external manager that's essentially non-cancelable, finding a better way to handle that so that the cost of capital differential wouldn't be so dramatic would be a good start as well. At the end of the day, though, we're putting a lot of energy into finding a structure that's not as good as one that's tried, true, and tested, which is the internally advised structure.
Lastly, where do you see opportunities for investors when it comes to externally advised companies?
The obvious area to start would be to internalize, right? And in the advisory and consulting group at Green Street, we work with a lot of externally advised companies to help them think through things like that. So if you have a company that's trading at a significant discount to its peer set that's internally advised, just by internalizing, if you can close some of that gap, you can create significant value. That's one area. Another area of opportunity is for activist investors. Through proxy access and the ability to nominate slates for boards of directors and be able to sort of take control of a company, which we saw with Equity Commonwealth, for example, is another area for investors to pay attention to if you can identify the companies that would be targets. So those are two areas that would be worth paying attention to. The last area would be for acquisitions by other REITs or private companies. So if you've got a company trading well below net asset value and someone is willing to come through and pay NAV or close to NAV for those companies, if you can identify them, that's another area for investors to take advantage of. So those are the areas I'd be paying attention to if I were focused on externally advised REITs.
Phil, thank you so much for your insights.
Thanks for having me.
For more from REITweek 2016, be sure to visit REIT.com.